Matt Lives, thanks for coming on the podcast. Appreciate it, man.
Thank you. Thank you for having me. What an honor. I'm on CNBC right now with Matt Hubbard here.
Well, not quite, but hopefully one day it'll be almost like a Joe Rogan type of viewership, or what that kind of level of famous. But I see you're rocking BYU swag as well.
Of course, always got to represent the mug, the shirt, everything.
One of my favorite memories of us is when we first started the MBA program. We were both living up in Salt Lake, right? And the very first day, like the orientation, they were like, okay, like dress up and like come down, like dress up and come to like the full day orientation or whatever. And we were both living up in Salt Lake, and so we carpooled down, and we were both wearing white shirts and ties. And it felt like we were LDS missionaries, because you have like a Corolla or Camry too, right? I guess the only thing different was we were listening to Rage Against the Machine at like 7 o'clock in the morning.
Yeah, the tunes were on fire, like 6 a.m. and we were jamming. That was, yeah, that's been my BYU guilty pleasure. Not a lot of people. You can listen to metal and go to BYU. It is a thing. There's a community of us. We're strong.
Yeah, definitely. As I notice the guitar in the background there.
Oh yeah.
Well, I won't say you pulled the highest starting salary out of all of the MBA grads, but you definitely maybe the top one or two. So you definitely listen to heavy metal and can still surprise people.
You can still make your parents proud, even if you disappoint them with your metal music.
That's true. All right. Well, let's talk a little bit about financial markets, inflation, growth stocks, value stocks. Why don't you tell us a little bit about your background? Like, what makes you qualified to speak on like financial markets?
Yeah, what a loaded question. So my path through careers in finance. So I was a finance major in school, originally studied economics, found myself in finance instead. A friend helped me join his sponsor finance banking group at a local commercial bank. So I got to help with leverage finance there, be a part of a lot of really cool transactions. Eventually got bored with that, didn't really see any opportunity for myself. And that's where me and Hubbard at the same time collided, and both of us actually, we were part of the same church group, and we said, hey, let's go do this BYU MBA thing. This could be pretty cool. And both of us ended up doing it. And so interestingly, both Hubbard and I said, hey, we're both academically oriented. We're curious. Let's look at different routes in PhDs and let's consider that. Now, interestingly, we met with a bunch of PhDs. I remember meeting with one of the economists from Duff and Phelps, who is not Duff and Phelps, excuse me, Dodge and Cox, big asset manager.
Yep, San Francisco. Wow,
and he sat us down very kindly and said, all right, let me give you like 12 reasons not to do a PhD at this point. And both of us were like, oh, geez, okay. So maybe the job market's not the best time. Anyways, both Hubbard and I decided that we would become rather practitioners instead of academics. But both of us took the same quantitative classes. I took like the pre-PhD finance courses, and eventually found myself in this fortunate situation at one of the largest asset managers in the country, but one of the largest quantitative managers as well. They're called dimensional fund advisors. So I work on a team there where we're essentially the product specialists, the subject matter experts in our equity portfolio. So we explain our performance to clients, things like portfolio construction, underperformance or overperformance relative to, let's say, an index. Also, advantages of a slightly active approach relative to an index, for example. So we're kind of a cross between, traditional active management where you pick, let's say, 50 stocks that you've done a lot of fundamental research on, and outright indexing, where we're kind of an in-between approach. Some people call it enhanced indexing, factor-based investing, but we choose these factors that are verified by, years of academic research. and then we invest according to these characteristics such as size, value, profitability, features that the evidence and the economic theory support as contributing to outperformance over time horizons. So that's kind of how I got to where I am. Very grateful. It's been really fun, really interesting. Like I told Hubbard, I'm running late because my manager pulled us all aside to, teach us the secrets of the kingdom for, various strategies that we advise. So it's been really interesting.
Yeah, totally. So a couple of thoughts I had when you were talking is one. So my high school econ teacher, they actually just recently created a little fund for high school students. It's like $30,000 that they invest, which is cool. But he's been rather active in the markets since like early 2000s, and I guess every week students will text and be like, hey, are you invested in Tesla? Are you invested in Bitcoin? Are you invested in this? And he's like, nope, I'm just straight indexed. You can't try to time the market. As soon as you try to time the market, like you either get overconfidence or you get lucky, or it's just pure random, right? You just get, it's randomness. So what is the advantage? Like, what would you say to someone who is like, no, like, I don't want to pay the extra fees for essentially like random performance, like why do the enhanced indexing?
Yeah. Ooh. So I'll add as a caveat that
you're a classical kind of guy too, right? You don't believe that, you believe in indexing, not as much active management. Why the enhanced indexing?
Absolutely. So the fundamental theory, so if you think about your valuation equation that you learned in your finance classes or in your economic classes, that the price of an asset is going to equal the sum of its expected future cash flows divided by some kind of discount factor, discount rate, right?
Yep.
And all things equal, so if you have a security that has a lower price but has the exact same expected cash flow, it must needs be, just like a tautological kind of thing, that you'll have a higher discount rate. So the idea is essentially that not all securities have the same required rate of return. For certain riskier securities, for example, investors are going to demand higher returns. And so what we do specifically is we target that subset of those securities. And again, to your point, it's not the right approach for all investors because there are opportunity costs from deviating away from the market. Markets are quite efficient. Obviously, there are flaws and there are questions that people have nowadays with the efficient markets hypothesis. And it's very important to remember it is just a model. Models are meant to describe behavior and provide useful insights and not encapsulate every single possibility. But according to that model, prices they quickly incorporate information, and specifically things like relative price, so buying cheaper securities as opposed to more expensive. That is something that history and the theory predict that will outperform in the long run. So even if you have, let's say, a really bad 2020 where you have a tail event and value stocks, for example, are harshed on, you can still expect the expected return in the future is still positive. So that evidence can give investors confidence when they are deviating from an index. And then also another anecdotal point, if you have an index fund, for example, let's look at the Tesla example where largest ever stock added to the S&P 500, and then there were major plumbing issues with that where, because everyone knew it was coming in, there were a lot of people that were able to very easily take advantage of the index fund. So there are advantages to the flexibility. GameStop is another fantastic example where an index was not able to get out at the top of GameStop, whereas a flexible manager was able to get out at the top. So two examples of how you might compare an active approach like ours to an index fund, right?
Yeah, that's a good part. I realize I should probably back up. Let's talk just like very basic, like describe terms like index. What is an index fund?
Yeah, so an index fund, so you'll have a company that provides an index fund, so MSCI, Russell, Standard & Poor's, and they'll design baskets of companies that represent certain characteristics. So the S&P 500 specifically are 500 of the largest stocks in the US and that are diversified well across the industries in the US. So in other words, it's a good snapshot of the largest companies in the US and their industry representation. An index fund does not deviate from those allocations whatsoever. So if you think about it one way, if I put money into an ETF, for example, an exchange traded fund or a mutual fund that tracks an index fund, their goal is to minimize their tracking error with the portfolio or their deviation against that portfolio. So generally what that means is that at the end of the day, they're going to see exactly where prices land and they're going to make their transactions exactly at that moment. This is in the case of an inflow, for example. So you're required to buy oftentimes at the least opportune moment. So when the volume, when prices might be bid up, for example, or you're required to buy when Tesla is added to the index, even if the prices are at these very strange, unexplainable highs, and if you know that there are going to be other traders front running that, because you're an index fund, this is the process, trust the process, and you'll buy in at that time, right? So it's very structured, it's very regulated, it doesn't rebalance very often. So certain funds might only rebalance once a year, and so there can be certain effects to that, so deviating from what might be seen as ideal allocations, because a lot happens with security prices in a year. So different advantages to investing in an index fund. And remember, an index fund is a fund that tracks the index. That's something that can be confusing for a lot of investors. And there are different providers, different index funds that all track the same index and have slightly different fees. But that's the basic skinny on what an index fund is and some of the weaknesses of an indexed approach.
Yeah, that's helpful. And of the theory is that you can by diversifying or taking approach of taking the whole market, you can lower your overall risk, but still get the same expected returns versus investing in like 2 or 3 single stocks. And this is really, it was a famous paper in the 50s. We read it, I think, or like reviewed it in the financial economics. Basically, there's this guy, University of Chicago, I think, who basically discovered that, you can diversify your stocks, basically buy the whole market, and your expected return is the same, but you lower your overall risk of your portfolio, which is pretty which is why index funds are popular. You're telling investors, hey, you're still going to get the same expected return, but with overall less risk than buying 2 or 3 stocks, which is great. And generally the fees are a lot lower for an index fund, because managers aren't you're not paying someone. It's tied to the market and just follows the market. And there's really not a lot of active management or things that need to happen for that fund. But as Lips was pointing out, that because it's not active, or you don't get this advantage of flexibility of timing, you basically have to follow hey, this is when we buy, reallocate the portfolio, or this is when we buy buy shares of the whole market. It's not as flexible as if you were managing a bunch of stocks yourself.
Exactly. And to be clear, most quantitative managers, so dimensional, for example, the trade-off might be between holding 3,000 names in an index fund like the Russell 3000 and maybe holding 2,000, right? So generally, we still, when we design portfolios, we take into account the opportunity cost of deviating from the market, which can be very significant. And a lot of times it depends on the exact strategy that's appropriate for you. So if it's appropriate to get something that's a really narrow strategies, but certainly we seek the gains from diversification. And we also, we don't have to employ thousands of or hundreds of analysts to look at the fundamentals of these stocks, you can have a computer essentially do these things for you, sort the stocks and choose whatever, narrower basket is appropriate for you and what makes sense from a deviation standpoint.
That's great. Yeah, that's a good point. I kind of want to switch gears a little bit. Let's talk. So we're talking about efficient markets, and efficient markets basically says like markets encapsulate all known information in the price, and that the price is accurately predicted. Now, in school, you are kind of more like, hey, Tesla's not that great of a company. I think one of the quotes you said, or someone you quoted, is like, what's Tesla's valuation but a lie agreed upon, or something like that.
That's Nietzsche, by the way. I paraphrase.
Yeah. That's right. And I was having this discussion with someone else too. Like, a lot of the BYU professors like didn't like Tesla, didn't like Bitcoin. Well, there were some other stocks, and my friend and I were saying, basically, if we went against everything BYU professor said last year, we would have made a lot of money. A lot of money. So what do you say to that? Like, what do you say to like Tesla was like, last year it was, I forget what the price, but now it's like all-time high. I mean, we would have gotten like 500% return if we had not listened to the professors.
So, yeah, thank you for coercing me into a public apology to Tesla investors.
No, that's what I'm saying. If prices are efficient, how could Tesla all of a sudden more than double in price in under a year?
Yeah, I agree. And I will add as context, there are many, so changes in stock prices reflect changes in underlying information. And there's been a lot of changes in information for Tesla that were unexpected. So there's an expected component of return that you can model out a little bit, and then there's unexpected. So unexpected might be the whole market crashing due to the coronavirus last year, right? Unexpected might also mean, let's say, a handful of FANG stocks achieving dominance of the entire internet, for example, right? Those are unexpected returns, but that were realized. So with Tesla, for example, one, you see that there's been a lot of unexpected good news. Two, there's still a lot of pricing in it that doesn't appear to be explained by the fundamentals. From an efficient markets hypothesis, that doesn't necessarily negate saying, okay, everyone in the market's irrational, the theory no longer applies, but there's also this additional layer on the efficient markets hypothesis that's investor preferences and taste, for example. So for example, think of, when you turn on CNBC and every time someone on there says, I was an early investor in Uber, right? There's a lot of marketing that comes from being able to say you were a first mover, right? Yeah. So even though Tesla might ultimately have lottery-like payoffs, so for example, there's a lower probability that it achieves everything that it's expected to do. It looks really good if you can say you were in Tesla before the stock split or back when it was at $90 a share and everyone thought they were going to go bankrupt. Also, there's a definite ESG edge to it. So it's another thing where investors might have different tastes and preferences that dictate how specifically they invest, that ultimately, again, the theory would predict that these things will lead to lower expected returns in the future, kind of like a bond price. When a bond price goes up, then its yield goes down. And that's exactly still what I expect with Tesla. So even though I've been wrong the past 9 months, if every morning, if you wake me up and say, Matt, what's going to happen to Tesla? I'm going to say, all right, it'll have lower expected returns, possibly negative. My personal opinion is still that its valuation will compress significantly, that there's a lot of meaningful competition. It's a circus out there. It's crazy, but you can't discount the value of people seeking these lottery-like returns. And we haven't even gotten into the meme space. I'm not qualified to talk on the psychology behind all of that. But no, I don't think it's the death of the efficient markets hypothesis. It's just an additional layer. And this is even before talking about behavioral effects as well, which are significant and also help explain behavior. as does the efficient markets hypothesis.
Yeah, so I remember when we took our trip to New York. I don't know if you remember this, but we visited a lot of big asset managers in New York City, and it was awesome, a great trip. I mean, that's part of the reason why I wanted to get an MBA is you get these kind of trips. But we asked a really large asset manager in New York City. I don't know if you remember. The question I asked was like, you know, index funds is overtaken. The amount of money in index funds is overtaken the amount of money in active management. And I was like, this asset manager is active manager. It's like, how has that impacted your business? And they've said they've noticed a lot of their clients or a lot of retail investors will split. They'll say, okay, I have like 60-70% of my retirement in an index fund, like low cost, no fees. I just put it in, don't have to worry about. But the other 30% I'm going to take and I'm going to put it into an active management, or I'm going to actively manage it myself. And I'm going to be super risky with this money and seek those lottery type payoffs where it's like, yeah, maybe I lose like most of the time, but if I hit it big, then like it's going to be spectacular returns. Like it's going to be spectacular. And they said it's kind of like that bifurcation. So people automatically are sorting based off of like they're allocating. You could argue efficiently. They have a good chunk in this low risk, low fees, don't have to touch. But then the part that they have remaining, they're really aggressive with that remaining funds. And so I think maybe a little bit, especially with like the stimulus money and people just sitting around inside, that there is a little bit more of that people being super aggressive with that. I don't want to say play money, but extra money that they have, and they're just bidding up things like Tesla, GameStop, because it's like you said, like, oh, there's behavioral psychological things happening behind the scenes as well. So I don't know.
I always tell my retail investing friends that if you compare their risk profile or the amount of risk that they should accept in their portfolios and compare that with the billionaire, a billionaire can lose 99% of their wealth and still not experience meaningful marginal changes to their standard of living.
Yeah.
Whereas a small retail investor out of a 401k or other savings, to lose 99% of their income might be devastating, right? So there's a reason why you see a lot of that wealth divide. And you can also see that in terms of the asset allocation decisions of a lot of these investors, where a lot of moonshot choices do ultimately make sense for someone that has a lot more wealth than you and I do, right? So
yeah, well, I mean, I don't know. You just bought a house in Austin, so I guess you're doing all right. No.
I've learned the Utah house situation is getting out of hand too. So hopefully that's
Yeah,
it's wild out there. It's wild.
Yeah, I mean, people from California leaving high taxes to come to Utah where they can get some skiing, trading in the beach for the mountains. So, okay, two other questions I want to ask you. I know we're kind of pushing up on time. So I'll let you pick. So yields have been rising. 10-year Treasury yields have been rising steadily.
Love to see it. Love to see it.
So what does that mean for stock equities? And I guess why do you love to see it? And why do you think yields have been rising?
So there are two reasons why yields are rising specifically. And again, I'll be cautious here. And like I said, I don't. Hopefully, I'm speaking as an individual, not as my institution. So if compliance.
Well, I also want to say yields reflect the cost of borrowing for the U.S. government. I guess I should say that. So this is 10-year treasuries or bonds or 10-year treasury, and it's the rate at which the government can borrow money from the private markets, from individual investors. And individual investors have been pushing up yields, basically the rate at which the government can borrow, up higher and higher. So the government's having to pay a higher rate, especially in the last couple of months. Well, yeah.
Exactly. Yeah, and a really simplified framework for how to think about the drivers of that nominal yield that you see, so the actual numbers, is that it's the sum of one, what are called like real rates, or in other words, expectations for growth in the US, so to speak. And then two, inflation expectations, right? So what we expect inflation to be. And in this case, both of those are increasing. One, the real rate is increasing because we're starting to see economic activity return to normal, which is positive. And then two, we're also seeing inflation expectations increase because the Federal Reserve has continued to take action to, keep the economy on track and in this case, print a lot of dollars. And so there are a lot of scary things about unexpected inflation, but the positive news right now is if you look in the market, you can see, for example, the difference between these nominal government bond yields, right? And then inflation protected government bond yield, which is a different kind of financial instrument that's essentially designed to subtract any inflation from your return. So if you look at the difference between those, which are called break-even rates, you can see around what people expect inflation to be for the next, say, 5 or 10 years. From that standpoint, and again, saying that prices are a good predictor of all of the market's aggregated expectations, inflation still looks like for the next 10 years, people expect it to be between 2.5% thereabouts, depending on whether you look at the 5 or 10-year horizon. So in other words, the markets aren't pricing in runaway inflation, even though some market participants are preparing for that because it can be detrimental to a lot of savers. The reason why I cheer it on is, one, because the increase in real returns is positive, even if it has a short-term effect on some people's wealth. That means that for the next generation, if they're going to invest today, then they'll have higher expected returns in general going forward, which is great. The second thing is this is just a narrative and not what necessarily happens, is that this generally means a rotation into sectors of the economy that are more economically sensitive because of the increase in growth expectations, right? So companies like banks, oil producers, certain companies that have been disparaged during the pandemic are beginning to have positive returns. So areas where we had weakness in the economy previously are starting to improve. And that's what's positive. The reason why I say this is all conjecture at this point is because the long-term evidence is that changes in interest rate don't reliably predict the outperformance or the underperformance of things like growth and value stocks, for example. So while a lot of people, the narrative is self-fulfilling in a respect, but the good news is the underlying health of the economy is recovering. And a lot of these stocks that had relied on free money forever, that in my opinion were rather unrealistic expectations, they're starting to be punished. I believe Tesla is down this morning. Always a good day when
it follows what you think.
Yeah, exactly.
Yeah, so yeah, that's great, and that's kind of where I want to wrap up is a couple of points. Value is more like growth stocks, I guess. Growth stocks is more like these high, or an example of a growth stock would be Tesla, Facebook, these kind of high growth companies that you expect high growth in the next 5-10 years, like super high growth. Value stocks are, and maybe you can correct me if I'm wrong here, value stocks are ones that are, I don't want to say relatively cheap compared to the market, but they're good value for the price that you pay, and you expect them to come back up to like the median or the average return of the overall market.
Exactly. Yeah, it's a synonym for value is they often call it relative price. So one of the popular metrics that they'll use is they'll call it your book value of equity, or in other words, like all the money your company's ever made, how much stock there is in it, how much investors have paid into it, and then take what the market's willing to pay for that, and then scale that by that figure. And so you can get an idea of, let's say I'm a company and I've got this much cash, and if people are willing to pay more for $1 of Facebook cash than for $1 of Exxon cash or retained earnings, or what have you in this case, then that might reflect that you're a growth stock. So, and again, growth stocks have had a smashing past 10 years.
Well. Yeah.
Yeah.
I mean,
And
the invested in Facebook, any of the FANG stocks, Facebook, Apple, Google, let's see, Netflix, you would have done great. The last 10 years, you would have done really well. And if you would have invested in value, you wouldn't have been nowhere even near those level of returns.
yeah. And that's one of those things too. When you when you get out of bed and you say, what am I going to do today? What do I think is going to outperform in the future? That's a question an investor has to ask his or herself, where is the digital revolution, are we going to continue to see these outsized return to this smaller cabal of tech stocks, or are you going to start seeing more competition in that space? And again, it's very complicated. Prices are just super informative, and that's my experience in investing has been, it's very, very difficult to outguess where market prices are. But when you look forward, you want to think about, what does the future look like, and not what happened. You don't want to invest in Apple because it's returned 20% on average per year or whatever for the past 10 years. You want to look at the future, and if you look back at past titans like AT&T, IBM, GE, just because you were top dog once doesn't mean you'll continue to be the top dog forever. So buyer beware in that respect when it comes to that choice.
Yeah, I mean, you bring up a good point. GE used to be the Apple or the Google or whatever, name any tech stock today. That was GE back in the 90s, and like you couldn't go wrong. Like they dominated early 2000. Now they're worth like what, $6, $7 stock. I mean, and they're selling off assets left and right. So, and these things, no one's going to stay on top forever, which is a sign, I think, of a healthy, dynamic, competitive economy, where we don't want like an oligarchy type economy where there's a few large firms that dominate and there's no new up and coming sectors that take over. So so interesting. I think one of the best stories or advice someone gave to me was like, when you're constructing your portfolio, when you're building out your thing, do research, find a story, or like find your hypothesis, right? Like you say, I think X and this is going to happen over the next 5 years. Do the research to kind of back it up or provide, I guess, provide some substance to that theory, and then match your portfolio to your story. And as soon as you deviate from your story, then you're just kind of guessing, and you're not really trying to allocate what you think's happening. You're just guessing based off stock. So okay, so thanks for that. I appreciate you coming on. I guess the one other thing I wanted to mention was that with regards to inflation, when the economy is growing, you do kind of want the money to supply to grow as well, right? The economy is growing at 2%. That's generally why government officials, the Fed, targets 2% inflation, because historically the economy's grown at like 2 or 3%. So the extra money to grow with the economy. The concern, and you brought it up earlier, is like when there's unexpected inflation, and that really hits fixed income, or basically people that get a steady stream back in their investment, because the value of that dollars that they get back is worth less. So I guess, do you think there's any concern for unexpected inflation? You said the expected inflation is around 2 to 3%. But I realize it's just a guess, and you're just speaking it for yourself, an individual, not as the institution. But well, like, do you think unexpected inflation is a concern, or yeah, what are your thoughts?
I do, and I don't think we're going to become the Weimar Republic. At least not yet. I don't know when we will. We will eventually. I mean, nations fall, right?
Yeah.
But I'm not as worried about it, but I wouldn't be surprised if we had inflation exceed that 2% by twice as much, even 3 times as much in a short-term horizon. And the Fed has been kind of quiet on what tools they have, because essentially, in the same way that during a recession, they're only all of their tools were essentially some variation of throw money at the problem. With controlling inflation, it seems
money. Yeah.
Yeah, it essentially means taking away that money that we've come to love so much. So there are some, negative economic repercussions. There are also some positive ones, in my opinion. And again, like I said, I never did get that finance PhD, so I don't know if any of this is legit or not. But my opinion has been that in a nation where we have limited political willpower to manage spending, increase taxes, that in some regards, inflating away our problems is the only way to support what we're spending on things. And I don't have it modeled out, so I don't really know, and can't speak to this, what the effect is on wealth inequality. But one of my ideas is that essentially inflation prompts you to spend everything immediately rather than save. And so people that have aggregated large fortunes and have been, savers in effect, and have kept their money in capital markets, inflation will affect them disproportionately versus someone who's living paycheck to paycheck. So in some respects, if we did have a large amount of inflation, my hope is that might in some ways address wealth inequality. So in other words, it's not all doom and gloom. Essentially it's the equivalent of raising our taxes in some respect, which you can argue we might need to do. And then it's also there might be some knock-on effects. So inflation is very scary. Don't come to my house with torches because I downplayed the risks of inflation. But one, the risks of it being excessive are low. And then two, if it is excessive, then you might find that humbles our country in a way that allows for some rebuilding. So,
yeah. Awesome, Matt Lips. Thanks for coming on the hub. Thanks for coming on the podcast. Super appreciate you taking some time. I know you're busy, so yeah, I really appreciate it.
It's been a pleasure. Let me know if you have any YOLO plays in the future. So.
Sounds good, man. Hey, we'll see you.
Bye.